Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
It also does what's called, it subsidizes local producers to the detriment of local consumers. Capital controls don't allow the consumers to get their money out offshore. It doesn't allow the Chinese consumer to take advantage of all the goods of the West, all the opportunities that we're able to do, other investment opportunities offshore, whatever. And because of that, as I said, the local consumers really have one thing to do. They put their money in the bank, and it creates what's called a forced savings. That forced savings basically subsidizes the local producers because it creates a pool of funds for the banks to lend out to them at relatively low artificial interest rates. It also subsidizes foreign consumers, this undervaluation of the renminbi. Think of it in the U.S., and I'll get to very specific examples of this. But with the Chinese currency so low, we get to buy very increasingly high-quality imports from China at very, very low prices because of this undervaluation of the renminbi. But it's also the detriment to the ex-Asian producers. Other producers around the world are forced to compete with this massive undervaluation of the currencies. So you can see when you manipulate a currency, there's these benefits and these trade-offs. There's all these unintended consequences, and this is part of this whole what this policy has created in a very, very big way. It also creates ex-Asian corporate profits to the detriment of ex-Asian jobs. Let me explain that. Let me give you an example. Apple manufactures the iPod mostly, or at least it's fabricated in China. Apple, records massive profits from that, but in terms of jobs outside of Asia, outside of China, they're just not there. So they're recording very big profits without paying labor or labor costs to do it. Again, not faulting Apple. There's no reason they shouldn't do it given the environment. This is what's called, you may have heard this term, platform companies. These are companies that do a lot of manufacturing in China. They do a lot of design and research in the Western countries and do the manufacturing and fabrication in China in order to drive a lot of increased profitability, value-added profitability. You can also look at this undervaluation and cap controls, and because of the way the platform companies have taken advantage for this, it creates really a jobs in the West for a goods exchange, meaning we get very increasingly higher values, bargain goods from China, but we give away jobs to do it. A lot of the so-called free market economists see this as a natural trade-off, comparative advantage, things like that. I think that would be true if China wasn't so aggressive with their quid pro quo. What China requires, unlike any other country in which we trade with, they require domestic manufacturing. They don't, for the most part, allow you just to ship goods in. They want access to our technology, Western technology, and the Western companies have agreed to that and really bent over backwards because they see this giant burgeoning consumer market as the payoff in order to give up a lot of stuff that they wouldn't give up to trade with other countries. So that's where we get that jobs for good exchange, and I don't necessarily think it's a comparative advantage when the Western companies give away hundreds of billions of dollars of invested capital of their shareholders into technology in order to get to this consumer market that still hasn't lived up to expectations. It also creates a lot of pressure on the Asian bloc FX rates. Singapore and those other countries out there, Malaysia, South Korea, that have to compete against China, as I said, to the West, tend to do everything they can to suppress their currencies because China is suppressing their own. So from a bloc standpoint, we think ultimately if China changes this policy, you'll see some relief pressure on the Asian bloc currencies across the board. So when we do finally see the capital controls come off, if we do, and the renminbi allowed to start to work its way higher, I think you're going to see an appreciation of the entire Asian bloc, and would be the place to be, which is one of our scenarios that we can talk about. So in case I forget to talk about this point while I'm thinking about it now, I have it on another chart. But to show the pressure that's built against the Asian bloc currencies that play into China, as we know, exports have declined tremendously in China, really across the globe. We just saw a 40% decline in Japanese exports in May, 40% decline from May of last year. It's just a massive tanking of the export markets. And we've seen the current account surpluses of most of these countries fall dramatically. Yet the current account surplus of China has actually gone up. And we know their surplus to the U.S. has gone down. What that tells you right now is China is forcing a lot of the Asian bloc countries outside of them to take a lot of their goods. So in effect, those Asian bloc countries are recording extra declines in their surpluses, why China is actually benefiting. This is what as I said when I first started talking, the political ramifications are growing, and the tension between just the Asian bloc against China. Forget about the growing tensions in the West and the growing political tensions. Even in their own backyard, a lot of the countries are not happy at all with China because they continue to try and push these exports out in a world that isn't taking exports because global demand has fallen off the table. So the capital controls really create a lot of distortions. They really create this massive excess reserves. As I said, when you receive a currency and you're a Chinese company or a Chinese individual, and it's not always the case. Some institutions obviously reinvest offshore, but they're very tightly controlled and approved by the politicos. Their choice really is to put the money in the bank. And what this does, it tends to, what I said earlier, it tends to create forced savings. And China is very happy to have forced savings because they'd rather have forced savings in an export-driven economy. The forced savings give them a massive pool of funds to continue to strengthen their industrial base. So it's a significant policy that goes hand in hand with the suppression of the currency, the capital controls. Because they have to keep their currency pegged to the U.S. dollar, and because of the capital controls and the money can't get out, when the money comes in, China basically has to go in and buy up dollars in order to maintain this peg, and it creates a massive amount, a lot more liquidity than it should. It was creating a real inflationary problem internally before we went into the credit crunch. As you may remember, the analysts were starting to tell us that pretty soon China is going to start exporting inflation to the global economy, and it was because of this. They're forced to go in and sterilize, or partially sterilize. They can't completely sterilize, but to go in and do that, it creates more liquidity in the system. But what it also does, because the money can't get back out of China, it's like, the Roach Motel. Money gets in, but it can't get out. So what does that mean? China derives a massive amount of money in, as we know on the export side, needless to say. And if it can't get out, it really creates deflationary pressures externally. It just doesn't circulate to the other ex-Asian opportunities or back into the West that it would normally do. When money comes into us, into the U.S., our investors are looking to move it offshore or move it wherever we find the best opportunities. Our companies take our money and their money and they move it wherever they see the best opportunities. China they're not allowed to do that. So it creates what we call deflationary pressures externally, and that's very important in today's world when the world is really sucking wind for liquidity anywhere they can get it. China still isn't providing it. They're really providing a lot of deflation because of these capital controls. So the capital controls that they think support them ultimately are creating more tensions around the world.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.